I'd like to call the Investment Committee meeting to order. The first order of business is roll call, please.
Henry Jones.
Here.
Richard Costigan.
Here.
Margaret Brown. Here. John Chung, represented by Steve Juarez. Here. Rob Fechner. Good morning. Richard Gallahan. Here. Dana Hollinger.
Here.
Priya Mather.
Here.
David Miller.
Here.
Ramon Rubalcaba.
Good morning, Chair.
Bill Slayton.
Here.
Teresa Taylor.
Here.
Betty Yee.
Okay, thank you. The next order of business is Executive Report, Chief Investment Officer briefing, Mr. Eliopoulos.
Good morning, Mr. Chair, members of the Investment Committee. We have several important agenda items on the agenda today, including an action item with respect to asset allocation and a trilogy of information items on corporate governance, 6A, B, and C. This morning, I wanted to spend a few minutes talking about our senior leadership team in the investment office. I have devoted most of these morning discussions in the past to, either market topics or portfolio allocation or construction or trend information in the recent past. By contrast, today and this morning, I wanted to highlight some important additions and changes to our investment team going forward. I think, as this committee knows, investment belief number 10 is one of my favorites. If not, if I had to pick a favorite amongst the investment beliefs, it would be number 10. Teamwork is needed to achieve our goals and objectives, and essential for us to succeed as a team. We manage a very large and complex portfolio with assets all over the globe. Over 70% of these assets are managed internally here in Sacramento. The remaining 30%, roughly, are managed through a wide array of external partnerships. Looking back over the past 15 years, CalPERS has been able to fill leadership positions with a mix of internal talent as well as attracting external investment professionals to CalPERS. A very healthy mix, I think, over that time period. For example, global equity, which represents roughly half our portfolio in terms of assets, has been managed by an internal team who's been able to recruit and develop a set of leaders, really a lineage for some that have been here over the course of the past 15, 16 years, a lineage that draws quite on a straight line from Mark Anson to Christy Wood to Eric Baggeson to now Dan Bienvenu, a very cohesive succession over that period of time. Global fixed income and its related asset classes of inflation and liquidity, represents roughly 30% of the portfolio, round numbers. And for those portfolios, we've had the able leadership of Curtis Ishii to lead that team for over 30 years. And there's more to come on that later in my beginning talk this morning. Real assets, roughly 10% of the portfolio, has had a very similar leadership approach since 2007, I would say, from when I started to now under Paul Muchaka's leadership. As the committee is aware, we're currently recruiting for a leader for our private equity program, which represents the remaining 10% of the portfolio in terms of assets, and we expect to have that settled by this summer. Sarah Kaur is doing a very effective and able job in leading that group in this interim period. That survey now brings me to some newer developments that we've announced recently, and one I'd like to announce publicly today. In terms of some recent announcements, first, we have announced the selection of Beth Rickman as our inaugural or first managing investment director of sustainable investments, a new leadership position reflecting the growing importance of sustainable investment topics in our portfolio and really among institutional investors across the globe. Beth brings an investment background, including over 5 years in our real asset program, as well as a deep understanding and passion for sustainable investing to our team. She brings an added dimension to the team, complementing and augmenting the deep domain expertise of Ann Simpson on all topics with respect to governance and sustainability, to lead now our efforts to integrate ESG considerations into our decision-making. Beth will transition into this new role by the end of this current month. Second, we have announced the selection of Elizabeth Borky as Chief Operating Investment Officer. Elizabeth will start a month from now, May 14th. Actually, her first date here will be the investment committee meeting that Monday, May 14th. She's not here in the audience here today. She's in Zurich, Switzerland, hopefully maybe watching on the webcast. Elizabeth is the third of 3 successive external hires to this key leadership role of COIO, following Janine Gilliatt and Wiley Tollett. She brings a remarkable personal and professional set of global experiences to CalPERS. She grew up, and having grown up and moved with her French parents around the globe growing up, including significant time in Europe, the Middle East, and Asia. Elizabeth earned her PhD in mathematics in Switzerland and served in a succession of roles in investment banks in Europe, Japan, and Canada. She is currently the head of pension assets and liabilities at ABB, the large public company, technology company based in Zurich, Switzerland. She speaks French, German, English, and Japanese fluently. I think she will bring all of this experience to bear on behalf and for the benefit of CalPERS going forward. I'm very excited to introduce her to the investment committee next month. Her first official day, as I said, will be the investment committee meeting next month. At this point, I'd also like to thank very much Matt Flynn for his very able and very seamless and very experienced leadership during this interim period. Matt, thank you so much. Last, I said I would return, I would return to Curtis Ishii, and I would have a new announcement to make. And I suppose we all knew that there would be a day for an announcement like this at CalPERS. After more than 40 years at CalPERS, and as a leader of our fixed income program since May of 1999, Curtis has decided it is time to retire. His last full day in the office will be in May, but he'll be available as needed during the transition. Actually, May 8th will be his last full day in the office, and his retirement date will be in July of 2018. Arnie Phillips, one of the great team members Curtis has recruited and mentored here at CalPERS for since 1993, an investment director in our global fixed income, will act as the interim managing investment director during this interim period. And we will begin an immediate search period for the MID position going forward for global fixed income. A few words, if I may, on Mr. Curtis Ishii. I have a few things I want to say. Mainly, I want to say how much respect I have for him and his career of remarkable public service to CalPERS on behalf of all of our beneficiaries. A 40-year career dedicated to the public good is rare in public service. He, in addition to dedicating really his his professional life to the good of the public and our beneficiaries. He has been a mentor, a peer, a friend to so many of us here at CalPERS and within the investment office. He's built a truly great team. In addition to this remarkable run of public service, Curtis is an investor's investor. He's built within this public sector atmosphere and environment that CalPERS lives in. He's built a bottoms-up, fundamental, active portfolio stacked with people of talent and missionary zeal for earning risk-adjusted returns for CalPERS and our beneficiaries. A few notes on Curtis as an investor, and I'm summing up here just to give a heads up. But you know, over the span of Curtis's investment career, CalPERS has weathered a number of storms, and he's been at the center of guiding and steering the ship during this. To tick off just a few of the major ones, you know, in 1989, the crash of the high-yield bond market, the so-called Great Bond Market Massacre of 1994, the Asian financial crisis and Russian default crisis of 97 and 98, the dot-com bubble and accounting scandals of 2000 through 2002, the global financial crisis of 2007, 2008, the European debt crisis, the U.S. debt ceiling crisis, the U.S. credit rating downgrade from 2010 to 2011, the taper tantrum of 2013, and the steep correction in the Chinese stock market in 2015. Curtis has always been at the center of advice for the investment team, for chief investment officers over and over, and having served with him from 2007 and beyond to today, his advice and counsel and recommendations are respected and have provided great leadership to CalPERS over the years. Last, and I think this is the way Curtis would probably like a comment to start and finish, is the numbers. In addition to all this leadership and energy and vision that he's brought to his team in the investment office, Curtis is always focused on the numbers. And looking back from the time of his official leadership of the Global Fixed Income Program, some 20 years ago, the Global Fixed Income Program has earned an annualized return of 6.25%, which exceeds the annualized benchmark by 58 basis points over that same time period. This outperformance in excess of what we otherwise might have received from our benchmark results in approximately $4.3 billion of excess dollar return, as I said, over and above our program benchmark during his leadership. I can't thank him enough personally for his advice and counsel, and I think our whole investment team can't not only thank him for his leadership and his service, but wish him all the very best in a earned retirement. So with that, Mr. Chair, those are my remarks.
Okay, thank you very much for that report. And at this time, I'd like to take a moment of personal privilege. First, Curtis. On behalf of the Investment Committee, we want to thank you for all your dedication and hard work over 40 years with CalPERS. We've had a very lengthy and impressive state service career. You led one of the largest and most fundamental asset classes, fixed income, on our behalf. You assembled, mentored, and established a terrific team of investment professionals. We always appreciated your advice, recommendations, and counsel. Curtis, on behalf of the Investment Committee, we want to wish you a wonderful retired life ahead. We will miss your wisdom and experience, so congratulations, Curtis. And second, Beth. On behalf of the Investment Committee, congratulations on your appointment as Managing Investment Director of Sustainable Investments. We look forward to working with you and your team that provides centralized leadership in sustainability and environmental, social, and governance issues for the entire investment office. You are leading the important work of integrating ESG strategies into our asset classes. Beth brings an investment background and deep experience with sustainable investing, and ESG to this position. So welcome to your new position, Beth. And lastly, I would just like to acknowledge former board member Michael Bilbray is joining us in the audience today. Okay? Okay, with that, we will now move to the back to the agenda on consent items, action consent items. Do we have a motion? Moved by Ms. Taylor.
Second.
Second by Mrs. Hollinger. All those in favor say aye.
Aye.
Opposed? Seeing none, the item passes. I've not received a request to move anything from the information consent item, so we will move to action agenda item 5, asset allocation. Mr. Who's doing this one? Mr. Eliopoulos.
We'll give the team time to get here and approach, including our Iron Man, Eric Baggeson. Take your time, Eric.
It's a big group.
And I will turn this over to Eric to introduce the team and the agenda item. This is the first in a succession of asset allocation items on our affiliate funds to come over the next few months. So with that, and having ate up the time to get you guys settled, I'll turn it over to Eric.
Good morning, Eric Baggeson, part of the total trust level portfolio management team. Excuse me. We basically have the first in a series of agenda items that are coming up to you over the next couple of months. See if we can move this forward. Yeah, it is turned on. Can we advance the slide? Yeah, there we go. Perfect. Thank you. Anyway, over the next 3 months, we're going to be bringing to you a series of agenda items dealing with asset allocation elements related to the affiliate funds. And the affiliates tend to get a little bit of short shift given the size of the overall Public Employees Retirement Fund. And yet this represents a pretty significant pool of assets, up in the $15, $16 billion size, which, constitutes a very significant fund in of itself. But part of the fiduciary responsibility of the organization and you as a board attaches to the guidance that we provide to these affiliate programs. What we're doing with this is attempting to work off of the information that was developed during the asset allocation work for the PERF. So we want to roll that information body, if you will, through the structure of the affiliates in as reasonably expeditious manner as possible to try to retain the relevance of that data set attached to this. For today, we've got the first of these sort of 3 items, as I say, that will be being brought forward, and this is the structure of the asset allocation for the supplemental income plans. And again, these are defined contribution plans, basically, where members are choosing to save money in addition to the kind of retirement benefit that they may get as a defined benefit that they get as a public employee. To help us do this work, we've enlisted the assistance of R.V. Coons. And R.V. Coons is an outside consultant firm that actually has a fairly deep, or very deep, I should say, expertise in the structure of defined contribution plans. That is one element that we do not think that we are particular experts at, because a defined contribution plan really constitutes financial planning for individuals in contrast to an overall structure of a plan like the PERF, for example. So we basically make use of R.V. Coons' expertise to help bring context and relevance as to what's the right kind of a structure for individuals. The information in front of you is going to be presented by Christine Reese, who is a portfolio manager or investment manager within the global equity team, and Allison Lee, who's an investment manager in the trust level portfolio management team. I think we've got Dan up here as well. And I believe we also have R.V. Coons in the audience if there are potentially any questions that would be asked of R.V. Coons. But I think with that, I'm going to turn it over to Christine, who's going to be bringing some context and background information on the structure of this plan to you.
Thank you, Eric. So to start the presentation, I'll be reviewing the plans that comprise the supplemental income plans, the investment menu design, and the investment reviews that have been conducted, leading us up to this presentation. So let's see if we can get this to work. Okay. Where am I supposed to aim? Yes, thank you, and one more. Okay, thank you. So starting on page 5, this displays the 3 plans that are part of the Supplemental Income Plans program. The first is the Public Employees Deferred Compensation Fund. This is available to public agencies to contract for. We have 800 employers with about 27,000 employees participating in this plan, and they've have approximately $1.5 billion worth of retirement savings in this plan. The contributions are pre-tax, and the contributions and investment earnings grow tax deferred. This is a 457B plan. The second plan is the Placer County 401k, which is a sister plan to their deferred compensation plan, which is also in our deferred compensation plan. It is a 401k, so it does need to be called out as a separate plan. It is small, but it is invested in the same manner as the deferred compensation plan. And then the third plan is a supplemental contributions program, and this is available to state employees and members of the judges and legislators systems. This is an after-tax program where the earnings are tax deferred. And in some summary total, the program, we've got almost $1.7 billion in assets under management and covering about 37,000 participants. So moving into the investment menu, it's been designed in a tiered format. All right, where do I point? Okay, there we go. Okay, so it's been designed in a tiered format to provide options for participants that either have more or less investment expertise, time, or interest in managing their asset allocation. So on the left, Tier 1 is comprised of target date funds. These are custom age-based funds wherein the asset allocation is managed throughout the life of the fund. This is an option available to participants who, would really rather not spend the time or energy managing their own asset allocation or may not feel like they have the expertise. Tier 2 is core funds. We have 6 broadly diversified index funds, and these are available for participants that want to invest all or part of their account and manage their own asset allocation. And then Tier 3 is a self-managed account, and this is an option that employers in the program can contract for. This allows participants to invest in retail mutual funds and certificates of deposit if they're looking for something that's outside of our lineup. Delving into the investment funds that make up those tiers, thank you. On page 7, so for Tier 1, within the age-based asset allocation funds, we have 10 funds that tranche every 5 years. So the farthest dated fund is the 2055 fund, tranched every 5 years down to the income fund, which is the most conservative. Within Tier 2, we offer diversified index funds within each market. So we cover U.S. and international equities. We have an intermediate bond fund, a short-term bond fund, a diversified real asset fund, and a cash fund. And then, as I mentioned, for Tier 3, we have a variety, hundreds of mutual funds that are available to the participants, as well as certificates of deposit. Moving into a little bit more detail on each of these tiers within the target retirement date funds. So the mechanics are that the participant selects the fund with the date nearest their estimated retirement, and the asset allocation is managed for them. The investments are funds that we also utilize for the core funds. So the funds themselves are broadly diversified. We have a glide path associated with those funds, and Allison will speak to that in much more detail in her section of the presentation. And that glide path is based on our plan participant demographics. And then those funds are rebalanced using a very disciplined process. We advance the glide path annually, and we rebalance the individual funds back to policy allocations every quarter. So this is a really good option, again, for participants that want a very disciplined process for their asset allocation. Both industry usage and CalPERS usage is trending upwards. We have 60% of participants are 100% invested in the target date funds. Although they represent only 46% of balances, 67% of contributions are being directed toward the target date funds. The target date funds have also been set as the qualified default investment alternative. So if a participant joins the program and fails to make an investment selection, they will be placed in a target date fund according to their birth year. And then through this review, it is appropriate now at this time to add the 2060 fund. One thing I wanted to mention with regard to the tiers as well, although we've set up the design of the menu to be tiered, participants aren't constrained to any one tier. So if they would like to have part of their balances in target date funds and then manage part of their allocation, or potentially use the self-managed account, they can do so. On page 9, a little bit of information about the core funds. It's pretty much the opposite of the target date funds. There is no glide path. The participant is fully responsible for maintaining and managing their asset allocation over time. As I mentioned, within each of the index funds, there is broad diversification across the market. So they're not constrained to, say, a small cap, mid cap, large cap in the US market. We have a broad Russell 3000 fund that they can invest in. Participant usage is trending downward, 52% of balances and only 33% of contributions. And again, this is what we're seeing in the industry as well. On page 10 on the brokerage account, just really want to point out a couple of things. One is that although participants can utilize this window, these are retail mutual funds and they do have much higher investment management fees. And that participant usage within our program is in line with the industry at about 2%. So moving into some of the investment reviews that have been conducted leading up to this point. In 2013, we worked with RVK. We made some fairly comprehensive changes to the program. We moved from a mixture of active and index to 100% index. We closed the balanced funds that we had and reduced our fund lineup from 24 funds to 16 to provide simplification for the participants. And at that point in time, we also reviewed the glide path and opened the 2055 fund. Through this review, we didn't need to make any wholesale changes, but we did want to look at a couple of the investment options to ensure that they were still appropriate for the lineup. We looked at the cash fund and the bond fund. Now, the cash fund we looked at, as cash rates had been so low for so long after the great financial crisis, we wanted to make sure that this was still an appropriate option. And after our evaluation of what the market had to offer and the various risk-return scenarios, we determined that that the cash stiff fund is still appropriate for the lineup. As well, we looked at the fixed income option. Our investment manager had a couple of different offerings, one with more corporate bonds than government bonds. Again, through that evaluation, we made a determination that that really moved us away from our index and our indexing philosophy. It had some active management, and so we decided that the bond fund, the intermediate bond fund we currently have, is still appropriate. So Those are the end of my prepared remarks. Allison will be covering the glide path and the conclusion of the presentation, but I'm happy to answer any questions.
Why don't we finish the presentation and then we'll come back with questions?
Good morning. As Christy just presented, the Tier 1 target retirement date funds that utilize the glide path design is our qualified default investment alternative. So what are the advantages of a glide path design? So here, if you look at slide 13, here are two glide paths. The main goal of a glide path is to adjust asset allocation according to where the participants reside according to the timeline at the end. So there are two distinctive periods along this timeline separated by the date of retirement. During the accumulation period, that's when participants work and save to accumulate financial assets. Then after retirement, they will withdraw from financial assets. Finance theory indicates that at the beginning of the accumulation periods, when the participants' human capital are much higher than their financial capital and their investment horizon are long, they have higher risk tolerance and gain more utility from exposure to growth risk. So that formed the plateau phase when the allocation to risky assets, here measured as total equity plus real assets, is the highest. So as time went by, participants gradually approach retirement. Their human capital decreases, financial capital increases relative to each other. The glide path will diligently reduce exposure to risky assets in a risk-controlled framework, forming the de-risking phase. In the end, the glide path will arrive at the landing phase. That's when the human capital has been depleted and the participants have low risk tolerance. They gain more utility from having liquidity in their financial assets. That's the period when the allocation to risky assets is the lowest. So each glide path will have the same shape, but there could be a significant difference, which is it optimal to glide to the landing phase at the point of retirement, which is the glide to approach represented by the right line, or is it optimal to glide through the retirement date and land sometime afterwards, which is the glide through approach represented by the blue line. So the level and the length of the plateau phase, the slope of the de-risking phase, the level and the starting point of the landing phase varies among glide paths. So those are the basic elements of the glide path. The next slide just lists the utility of the glide path. Then we come to our consultant, RVK's stochastic optimization process in designing the glide path. So during the accumulation period, RVK project a balanced accumulation by collecting the following input. They collect inflation rates from a macroeconomic forecasting model. The expected investment return is adopted from 2017 CalPERS asset liability management process. And the salary growth is collected from 2017 CalPERS experience study. And the participant contribution is based on the calendar year 2016 CalPERS S&P full 57 plan participants data. Then during the distribution period, RVK will project income adequacy by modeling an annual income replacement goal, the household income resources, the annual distribution pattern based on CalPERS data, public governmental data, and the recognized retirement studies. And the modeling of inflation and investment returns are carried over from the first period. So after completely modeling out the two periods, RVK's stochastic optimization process will try to build a glide path by either maximizing replacement income without significantly decrease the portfolio volatility, or by minimizing portfolio volatility without significantly decreasing replacement income in each run of 2,000 iterations. And also, besides these two measures, a couple of other risk return measures are also constantly measured to prevent deterioration. So after each run, the process will change or modify the glide path according to the feedback. In the end, one glide path will be chosen based on an overview of all the risk return measures. So that's the RVK process. In choosing the glide path, then RVK looked at, if you look at, slide 17, RVK look at our participant distribution patterns to answer the glide to versus glide through question. Although there's a profusion of data here, but we think it's worthwhile to present all row A, B, C, and D because they add up to 100%. In cases when they do not add up to 100%, that's because of rounding error. So for meaningful information, if you look at row A, the first full column, it says the majority of participants actually did not make any distribution before the age of 70. But if you look at the last column of row A, it says 31 of the participants did make some distribution after the age of 65. Secondly, we think this data tells us the importance of separating participants fully depleted, which is they are separated into rollover, which is row C, and the full cash distribution and row D, because research indicates participants who opt out for rollover remain invested in capital markets, including a higher allocation to equity. So those three rows of data indicates a glide through design is a better fit for the CalPERS SIP participants. So the next slide lists the input into the RVK optimization process based on their analysis of our participants' data. So for a typical medium full career CalPERS SIP participants, he started investing at age of 23 with a beginning balance of 1,800, and the contribution rate is from 1.8% to 3.2% per year. It's a two household member. They will retire at age of 58, start withdrawal from the SIP plans at age of 65. They have a 81 income replacement goal. The period estimated is 36 plus years. That's from 23 to 58. After retirement, the length in retirement is depending on the model for household life expectancy. So slide 20 present the glide path recommended by RVK based on their analysis of the input and their stochastic optimization process. This glide path is built to provide a trade-off between improving replacement income in retirement and protection against a significant drawdown due to market turbulence. So this have a longer plateau phase, and also it's adopted a glide-through approach, so it will land at the landing phase after retirement. And on the next slide shows the recommended the glide path within the Morningstar universe. As you can see, the recommended glide path is within the first quintile of the as to exposure to risky assets, and its length is longer by under 5 years. We think this is a worthwhile trade-off because a typical S&P participant is more risk tolerant because of their pension payment from PERF. And on the other hand, the Morningstar universe is a collection of off-the-shelf product which is not tailor-made for the participants' demographics. And also, most of the glide paths within the Morningstar universe have an active component, which means either the weights or the underlying portfolio representing the asset classes are actively managed. Comparatively, our S&P plan are passively managed, so the Morningstar universe could be more risky than it's presented here. The next two slides will compare the retirement income based on the recommended glide path as compared to the current glide path. So the recommended glide paths have a better retirement income in terms of it will have a higher ending balance, a higher annualized return, and a lower probability of shortfall. The replacement income from S&P plan increased from 4.3% to 5.8%. And of course, this is at the expense of a slight increase in annualized volatility, increased from 10.4% to 13.6%. So pending the approval of the new recommended glide path, the implementation steps will follow. We'll update the investment policy and conduct communications with participants and the employers, open the 2060 funds, and the new glide path will be effective on October the 1st this year. So that concludes my part of the presentation, and we are ready to answer questions.
Okay, yes. I have a general question first before we get into the specifics, and that's dealing with our fiduciary responsibility, the board's fiduciary responsibility. And I'm not so sure that that question can be answered by any of you here, but when I looked at the presentation and you talked about, first of all, the participants have options to select. So I understand the PERF fiduciary responsibility because we make all those decisions, but now this is a shared decision-making process with the participants also making it. The second part of that question is, when I looked at the glide path and the universe, the recommendation is even more riskier than the universe when you just said that the universe is even more risky than presented. So why are we going beyond the universe in this recommendation when it's already more risky when you just said that the universe is even more risky than presented?
I'm sorry, like maybe I was not clear. The universe, it could be more risky, but it's not shown on the graph here, because graph here just showed the target static allocation to risky assets. But many of the plans within the universe, they actively manage that target, and also the portfolio representing the target is actively managed. Well, we do not have that active component, because when you introduce an active component, the volatility will be much higher. But that information is not shown on the graph.
Okay, that answers part of the question.
Yeah, let me add a little bit of context also to Allison's comments. In other words, the implication of what Allison just said, I don't know if we can flip back to that. chart so that everybody can see it, basically. The implication of what Allison just said is that the area covered by the blue shading around the sort of mean element on this is potentially wider by the effect of asset allocation activities or active risk management, for example, than as would be stated just by the averages attached to this. So you'd probably have potentially a wider distribution of outcomes. So that's not reflected in that blue shading. The other thing that's most telling about this, though, is that when Arvie Kuhns designs this, they operate with knowledge that the beneficiaries of this also have a defined benefit. If you're Fidelity or you're Vanguard or some other organization that is constructing a glide path in a 401k DC plan, they have to treat that like that's the only retirement plan that someone has. So the element of replacement income that these represent to our beneficiaries is significantly less, and they do not have market risk attached to that defined benefit. That market risk is being borne basically by the employers on their behalf. So in the judgment of Arvie Kuhns, that enables this plan to carry a little bit more risk on the defined contribution side than would potentially otherwise be advisable. And I think that's really the context around this that lets them arrive at this conclusion. It's that full understanding of that demographic information.
Okay, and the fiduciary question is Matt around.
I'll see if I can take a crack at that, Mr. Jones. DNB Avenue, Global Equity. From a fiduciary standpoint, the critical component here, as you say, the participants select. So what they select is kind of on them. The critical component for us and for your fiduciary duty is that what we offer is prudent. So as long as the offering is considered prudent, then you're covered from a fiduciary standpoint.
Okay. Okay,
Does
I'll
that
take
help?
that for. Oh, no, Steve was first. Sorry. No, how did that happen? Okay, no, Steve was first. Yeah, you're third. Mr. Juarez?
Yeah, thank you. And that makes perfect sense to me, the fact that you have folks that have other sources of retirement income, and therefore you can afford to be a little riskier with this portfolio. So I get that, and I appreciate also the fiduciary arguments. My interest comes from a perspective of someone who's helping get a 401k program off the ground for the state called Secure Choice, but more familiar now we're calling it CalSavers. And so what I'm hopeful is that we can get information from you all, recognizing that we have different audiences. The folks that we will likely help invest don't have the same resources that the folks that you assist do. But I think we can learn a lot, and so my hope is that, especially from your 2013 study when you looked at what you decided to offer, and I'll look to Marcy to help gather that information for us, and then maybe even arrange for a meeting, if possible, so that we can get the best advice as to how you put your program together, and hopefully gain from that expertise. So that would be my request, personally, just to the folks at the table.
Yeah, I think, Mr. Juarez, that basically, to the extent if CalPERS is going to construct a plan that would represent the general public in contrast to the beneficiaries of the public employee retirement system, that, again, we would reach out to an organization such as Arvie Kuhns that has real expertise in that arena. We do not profess to have that individual financial planning expertise, and that's really what the reason for bringing in an organization that has a much deeper experience in that arena. And I would suggest, so that probably, and I'm only guessing at this point, but the outcome that you would see of that analysis would look more like that Morningstar universe, because again, you would not be able to have that potential risk tolerance that engenders from the participation in the PERF. But certainly we can arrange all that information to happen and bring you through the work that was done as this plan was restructured and simplified in 2013.
That'd be great.
We can revisit all of that for you.
Thank you.
Okay, so the takeaway is that you will coordinate the meeting with the consultant with the Treasurer's Office.
That'd be wonderful. Thank you very much for that.
Thank you. Mr. Costigan.
Thank you, Mr. Chair. So I have a few questions. So first of all, I appreciate the presentation, and I'll start off with, I've had concerns with this program over the years. I'm not sure why you have a bifurcated system where state employees are in one plan and Placer County's in the other, and why we're picking up Placer County's cost and why Placer County can't actually do this themselves. So, I mean, there's a bigger issue to have, because I'm actually going to get into some stuff on Placer County. Voya is the provider, is that correct?
Voya is the third-party administrator for the program.
And so I'll just talk as it relates to my experience. So Nationwide is the provider for the state's 401, 457 supplemental plan, which is the same one. So make it clear, state employees don't have access to this program. And we're actually giving county employees some benefit that our other state workers don't get, which I'm still trying to figure out why we do this. This has been a historical issue. Voya is the one that sets, so similar to, so Schwab has index and age-based funds, or Nationwide, that you can pick, and then you run the self-directed, and what I believe CalHR does is then contract with Schwab, and Schwab runs the self-directed account, which is actually where most of my funds are, and then you run your financial planning through the Schwab Financial Services. Okay, does Voya do that for Placer County's employees? Is that what, or the other consulting firm? So I go in, I've hired a financial planner through Schwab that looks at all of my assets, and we run my plan. So does Voya do that?
No, so this program doesn't currently have managed accounts as part of the program. So we've contracted through Schwab to offer the PCRA Personal Choice Retirement Account. That's the self-managed account. But Voya does not provide what are also called managed accounts for participants in terms of giving advice and actively managing their account across allocations.
Which again starts begging the question, why are we doing this in Placer County, not just contracting directly, or why aren't we bringing in Savings Plus for the state into I see Eric wants to answer that.
Yeah, could I actually suggest, the questions that you're raising also relate to your fiduciary responsibilities as a board for structuring this plan. But for the investment committee, basically, the discussion today is really around the asset allocation. I think that to get into the other elements of the plan, what the administrator does, the costs of the plan, a number of other dimensions, that's actually a discussion for a different venue than the investment committee. I think that that legitimately belongs potentially in the CFO's committee and the finance and admin committee. So I think that that's a piece of a body of information that's worth exploring, but I don't think we're ready to answer that information today because, again, that's not the dimension that we've done work on. We've really constrained this to just the structure of the asset allocation, Mr. Costigan, and I'm not answering your question, but I'm hopeful.
I would say with all due respect, I have difficulties voting on something without having the holistic view, because you're asking me to vote on a plan that may impact my fiduciary obligation, which sort of leads to the questions I think Mr. Jones raised. Placer County on its website really makes this about CalPERS, which I have some significant concerns about. Let me just quote from them. As the largest pension provider in the state, you can rely on CalPERS to help you get the most from your retirement benefit. Your pension and the CalPERS 457 plan are designed to complement each other. So how are we complementing the two plans?
So I'm not sure if they show that information on both their 401k website and the 457, but in the 457, they are contracted with us, as are all of the other employers. The 401k plan is a separate plan. So I'm not sure if they make those same claims on the 401k side, but they are the plan sponsor for that plan and retain fiduciary duty.
Except in their marketing materials, it appears to make us responsible for, in fact, just as an aside, the website that they use is www.calpers457.checkappointments.com. So who runs that plan?
So the 457, they are a participant in our 457 plan. On the 401k plan, they retain separate fiduciary responsibility, and the investment structure is the same for their 401k plan as it is for the 457, but it's not part of the 457 deferred comp plan.
Well, I'm just concerned about the way it's marketed. And then just last couple questions. Eric, I do appreciate you coming back and cleaning up the DB versus DC, because the problem with slide 18, I was just doing some back of the math calculation. Without your explanation, an employee that started in 1984 making $24,000 would, after 36 years, would have had to make $63,513 with a $233 monthly contribution at 5% to make $1,286,199 to account for 81% of their income. That's the back of the envelope. Because the way this chart reads is someone starting at age 23, so you go back to 1982, plug in 24,000. I picked a random salary, 24,000 applied COLA going across the federal calculation going forward to today, backing in with a 5% return. of this 81% replacement goal, what does the 401, 457 on your glide path, what's the percentage that accounts for outside of the DB?
It's 5.8%. If you adopt the recommended glide path. The 81% is a goal. So it's based on recognized retirement study, A1 consulting company and the Georgia State University. Basically, it looks at the consumption requirement of a person who's retired, how much income you need to replace while you're working. And people recognize 81% is a reasonable goal.
I'm not disagreeing with the 81%. What I was just trying to get at is as you're putting this out, I was just trying to back into a number. And so for this plan, I just want to make sure I heard this correctly, of that 81%, you're saying the 401, 450 supplemental, the supplemental income program only accounts for 5.8 problem. 5.8%.
Yes.
5.8% of the 81%.
Yes.
Okay, so the majority
it's 5.8% of your income. That's like within the 81%.
Correct. So of the 81% replacement income,
right,
5.8% of it comes from this voluntary 401, 457. So in reality, 75% of someone's income under that is still coming through a DB.
Yes.
Okay. Thank you.
Mr. Koska, maybe when the lights dim, your time is up.
I know.
Okay, before I call on Ms. Martha, I just want to respond to Mr. Baggerson's comment. Any fiduciary responsibility discussion around this item or processes around this, I should come back to the investment committee. Okay? All right, Mrs. Martha.
So I think you've done a really good job of addressing the risk observations that the board's consultant raised, and specifically the three things that I heard you say, and correct me if I've misunderstood, is one, in the ways that our members are different and therefore can tolerate a slightly a delayed glide path down, is one, they have a defined benefit plan to rely on, and so this is supplemental income, not the core of their retirement savings. Two, they tend to make withdrawals later than perhaps other populations, and probably it's a result of their having a defined benefit plan. And three, that we have an indexed approach to these funds as opposed to an active management approach. So the Morningstar population does not, or universe, does not reflect what sort of the heightened risk that might be associated with that active management. Did I capture that correctly?
Yes, exactly.
Okay, thank you. So then then I do have one question, and that is, why with these funds do we plateau at the very end? My guess, my suspicion, and perhaps you can correct me if I'm wrong, is that people generally don't withdraw all of the money all at once. They're withdrawing it over time. And so I guess my question is, why doesn't the slope just become much flatter, but not completely flat once you hit sort of the first withdrawal date, or the estimated first withdrawal date?
Sorry, the distribution, based on our analysis of the distribution pattern, the withdrawal actually start at the age of 65. This is like for a typical medium participant. So basically the change is the current glide path, you will de-risk at the age of 30 and start withdrawal at 60. So we have 30 years of de-risking. And the recommended glide path, you start de-risking at the age of 40 and start withdrawing at 65. So 25 years of de-risking. So we think start de-risking at age of 40 is reasonable.
I don't argue with that. My question is really from the first date of distribution, or the assumed distribution date, at which point there's that landing period, or why does it have to be, why are you recommending that it be flat? And I appreciate that's probably the market standard, but should it not be at a slight slope, because people are not taking distributions all at once on the first distribution date?
That would just like increase the problem, like multiple fold of complexity, because if for design the glide path, we impose a lot of structure. We put in like 3-phase and like a linear de-risking, because if you want to just solve the question without structure, it will be like 40 years, and you have 5 asset classes, so that will be like 200 variables, and then you have to constrain their relative magnitude, so that will make the problem like intractable.
Okay.
That's why usually the design is put in 3-phase and a linear decline, and you could choose like an accelerated decline, but just based on a lot of simulation that has been done by the industry, that doesn't like improve the outcome. So this is kind of like the standard.
Okay.
Maybe I'll see if I can. Oh, I'm sorry. Go ahead, Eric.
I was just going to add a little bit more context also to Allison's comments. If we just flip back to the, whoops, sorry, went the wrong direction. If we actually look at this, in other words, what you see is basically you've had such a significant reduction in equity risk over this time period that by the time point that you've reached this, reducing the equity risk by 1 or 2% more over a yearly basis almost just adds a layer of complexity to this that has probably a virtually de minimis outcome, given that at this point in time you've got 2/3 of this program or more into more or less fixed assets. Yeah. So I think it's such a diminishing payoff to adding that other layer of complexity that I don't think anyone honestly truly believes that it's probably even worth incurring the transaction cost to make that happen, in contrast to just sort of locking that down into a terminal portfolio that can then operate, relatively straightforward with very little actual rebalancing activity.
Okay, thank you. That makes sense. Sorry,
I'm sorry. The one thing I would add to that, and just expanding on what Eric was saying, is that you'll notice that after the 2015, everybody goes into the income fund. So even though we had people that retired in 2010, 2005, probably people in the 1990s, we still just go to an income fund and it just stays there.
Okay. Well, with that, I'm comfortable with the recommendation, so I would move staff's recommended glide path.
Okay, to move by Ms. Martha, second by Mr. Slayton. Okay, Ms. Brown.
Thank you. I was looking at this agenda item, but attachment 2, the Wilshire report, page 3, and I just wanted somebody to address the 3 comments by Wilshire, because they say specifically they want to make sure that we understand several observations to ensure that the investment committee is comfortable with the risk characteristics embedded in the proposed changes. So I want to make sure those were addressed so we understand what those mean.
We'll call on Wilshire to.
Good morning, Steve Foresti from Wilshire Consulting. So I'll be brief, because I think you've touched on in the discussion that's already taken place the point that we were raising, which essentially is the portion of the glide path where the recommended allocation to equity and risk assets exceeds that Morningstar universe. And we set it up in several bullet points, but essentially the first 2 bullet points lead to that observation. And the first bullet point would be in the early part of the glide path, the allocation to these growth assets is within the universe, but at the high end of the universe. It then extends further along before de-risking, and as such, immediately prior to de-risking and then early in the de-risking glide path is outside of that universe. So as we noted in our letter, we're completely comfortable with the process, the inputs, the use of participant data, the sources for that information, the risk metrics that were assessed to understand the risk characteristics of different glide paths. We simply note that risk because it's difficult from the information that we've seen to really understand the trade-off for taking that pure risk. And you can, I think, count on Wilshire for always pointing out the importance, value, and sometimes where peer universes really aren't that important. You should be investing for your specific needs, and the most important thing in this is the participant universe. That being said, the key risk that staff pointed out in their cover letter to this agenda item is estimation risk. and the risk that the assumptions that go into the process are not realized through time. So while the peer universe may have its flaws, we've kind of talked about some of them this morning, that serves as a very nice check of other institutions that are going through a process of striking asset class assumptions, of trying to understand risk trade-offs for meeting income replacement in the future. And when you have an outlier point or a risk point that looks a bit different than that universe, albeit built on information and participant data that's specific to your objectives, it strikes us as a good checkpoint to step back and really understand what is the trade-off for accepting that risk. And to Ms. Lee's point during the presentation, she made the comment that that risk is well worth taking. Our only hesitation in having a full-throated support of the recommendation is that's just not a call that we feel like we were in a position to make, because we just didn't see the data on what that trade-off was. Said differently, if you constrained it to stay inside of that universe, it's just unclear, again, just from the information that we've seen, what the sacrifice is in terms of those important risk metrics that were reviewed, I think, on page 22 of the deck. So that was our perspective. We wanted to highlight the risk. It's not in any way to suggest that that risk isn't worth the trade-off. It's just that it is, I think, an important risk metric to consider.
Thank you.
Ms. Hollinger?
Thank you. Yeah, I have that. I share that same level of concern that we're going outside the risk metrics at a point where people have accumulated a significant amount of money. They don't necessarily have the time horizon. And so I wanted to know, and I didn't see the trade-off or the rationale for doing that. Did RVK give us the rationale, or are they here to speak to that?
There's a open cell. There's a seat. There's a seat over here also on the end.
Yeah.
Your mic.
Thank you very much. So my name is Rob Palmieri. I'm the head of the DC Solutions Group at RVK. Appreciate the opportunity to address the board or the investment committee. With me is Michele O'Connor, who is also a member of the DC Solutions Group at RVK. So there's been a good amount of discussion about risk, and that there is the trade-off question. If you go to, and I don't have a clicker here with me, but if you go to page 23. Yeah, thank you. So here's your current statistics, right? And so what we see here is that you've got an annualized return of 5.1% with a volatility currently of 10.4. Ending balance of 212. Replacement rate is 73%. You also have a probability of a shortfall of 83%, meaning you run out of money. And you run out of money in a 13-year time horizon. You also have a contribution level in order to bring that shortfall risk down of 3.6%. The replacement rate right now, currently, that the plan is producing for an income replacement ratio, which Mr. Koskin, we were talking a little bit about there, is 4.3%. So now if you go back to page 22, you'll see that these projections, based on the recommended glide path, improve. So you've got an annualized return that goes up significantly from 5.1% to 6%, so up 0.9%. The volatility, as Wilshire pointed out, actually does go up to 13.6%. So this is going to be the trade-off now. Your ending balance increases by $70,000 to $285. Your replacement ratio goes up by 3%. So that's an improvement. That's a good improvement. If you look at the probability shortfall, this is what's important. It goes down dramatically from 83% to 71%. So you improve your ability, you improve your shortfall risk significantly by 12 percentage points. And you extend your depletion rate out a year. So again, that shortens, that improves. Lastly, as you can see at the bottom, now you only need to additional 1.5% in contribution, additional contribution, in order to even improve that shortfall risk dramatically. Is there a question? Oh, you?
Go ahead.
That's assuming that you hit your numbers every year.
Yeah, well, over the long term, that's assuming over the life of a
as you go
participant.
longer out on the horizon, that volatility factor in terms of loss and time horizon, I mean,
well, you can. I mean, models are just so good, right?
Right.
I mean, you're absolutely correct. I mean, there's a big assumption here. So Eric actually explained. Let me talk a little bit more about the risk component, because Eric explained the sources of income. So you've got a defined benefit plan, and for some of your participants, we understand that you have Social Security even. So that's good. Those are two very good points or attributes about your plan relative to other plans, the universal plans. That's a positive, and that affords you the luxury of taking a little bit more volatility risk in order to achieve a much better income replacement ratio over the long term. The second point, which I don't think I heard anybody discuss, is that your time horizon, which I think you brought up, is that, and I think Allison mentioned this earlier, for a retiree, so you retire at 58, but your participants don't even start taking it until 65. And then, actually, the majority, I think it's about 70%, if I remember correctly, don't really start taking it until age 70, if I remember correctly. Yeah. So that time horizon is even longer, affording you more ability to take more risk.
I'm not uncomfortable with your projections during the early years. It's just later years, the outside.
Yeah. And your plan, specific to your plan, again, participants are not taking distributions at retirement. They're 12 years down. I think it was 31% at 65. And then most of them, the majority, take it at 70. So that time horizon is longer, affording you the luxury of taking a little bit more volatility.
Thank you.
Okay, McKelly, I don't know if you want to add to that?
I would also add that the median balance pre-retirement is $28,500. So this is, even though our projections show $285,000, that is for a participant who starts at age 23, contributes and stays in the plan, and at the end they should have, based on projections, that amount of money. But reality is, median balance is $28,000. So we know participants are not using this as an income source. They're not needing it as an income source right now, at least current retirees. That may change as benefits change over time. And so they're not using it. They don't need the liquidity. So we think of that as capacity. So they have capacity to take on more risk because they're not needing that liquidity because they're using other sources of income. And so that's based on the data. That's why we say they can take on a little bit more and have that as an additional buffer for whatever they are going to use their money for.
Okay. Ms. Yee.
Thank you, Mr. Chairman. I really appreciate this discussion, and especially taking what we've learned, the data that we've learned through the asset allocation process with the PERF and applying it here. And it seems to me that, and some of these questions will be tempered by the recognition that the participants in these plans have DB benefits as well. But that the assumptions with respect to the beginning age of drawdown, as well as maybe some economic assumptions I just wanted to be clear about. when we had the PERF asset allocation discussion, it was really assuming that this sustained economic expansion would be coming to an end soon, and certainly affecting our return projections. And I guess I'm wondering if applying that assumption to these plans, is it prudent to even think about increasing risk levels for these programs, even with the delayed drawdown by the participants?
So did you want?
Oh, I see Eric getting back up, and probably not a question for R.V. Coons. You know, the same capital market assumptions that we used for the ALM, we used for this. That's the first piece, and then the question I think you're asking then goes to really the timing, the market timing of when these changes, you know, may be made or not. And I think I'll let Eric answer that, but you know, our approach generally is we have regular time periods to do these asset allocations. We do quite a bit of work to assess the market assumptions and all the other factors into plan design. And we tend not to try and time the market in terms of when we think a downturn may or may not happen, especially as we set conditions for very long periods of time.
Yeah, I mean, I think Ted is exactly right in that space. When we do this work on the asset allocation, we try to come up with a set of estimates that we think are averages that it will exist over like a 10-year time frame. And obviously you can have markets can boom, markets can bust in that time period. But particularly in something like a defined contribution plan where people are contributing that money, in other words, even if the market blows off, that basically means that they're buying that risk exposure at a lower cost. So in reality, if you're in an accumulation phase, you would actually, you would prefer that the market not boom. You would actually prefer that the market blow off because you're buying assets for less expensive. So that is the time potentially to increase that risk. Now, the market has not blown off yet at this point in time, but relatively small amounts of money in any of these plans would be shifting into risk assets at this exact moment in time. Instead, this is a program of averaging into the marketplace over a 30 or 40-year period. So I think you just have to retain that time context on this and not necessarily anchor on what could or couldn't happen to the marketplace over a relatively short-term time frame, because that just creates a degree of uncertainty that makes it almost impossible to make a decision over something that is unknowable. You know, if you know, ultimately the structure of this plan and the structure of the PERF, we are basically taking market risk, growth-related risk, on the belief that that risk will ultimately be compensated, and will ultimately be compensated even through the thick and thin periods where the market blows off. And then, you know, if the market never recovers after the next time it sells off, then that'll be a poor bet to have made. But that'll be a bet that condition would be basically setting up virtually the entire financial system for failure. So there's no way that we can run this program to try to succeed where the rest of the economy is basically failing. That's, you know, we don't believe that that's an option that we have in front of us. And I personally, I wouldn't manage my own money in my own 401k program that way.
Yeah, I'm thinking about, obviously there's going to need to be a pretty robust communication component with the participants in these programs and the employers. But, and to Ms. Hollinger's point, I guess just some comfort. I mean, I'm personally of the belief that you know, costs for living in retirement are going to be more challenge going forward, and so I think the assumption about later drawdown may not hold. But to the extent that we do face a large downturn in the near term, and the impact on the near-term target date funds, 2025, 2030, 2035, you feel comfortable we have enough time to recover?
Can we have the clicker for a moment? I think if we look at the structure that's here, in other words, so what you see basically happening, right? The reason that these lines, the black line lies outside the Morningstar experience. It obviously starts a little bit higher, so I think you probably have another, I don't know, maybe 5% equity exposure on top of the average in the Morningstar universe right at the very beginning of the accumulation phase. It's the lengthening of that plateau period, though, for another 5 years that causes that hink, and then you have a steeper path. So this actually de-risks at a accelerated rate over the Morningstar universe. So for the plans for the individuals that are closer to retirement, their plan under this kind of a program would be de-risking at a speed faster or a rate faster than it would be if they were associated with the Morningstar average, let's say. So I think that that plays into exactly the comment that you just made, Ms. Yee, in that regard, that, if the market should fall apart, the people that are closer to needing that money would be basically having risk taken off the table at a rate actually faster than the Morningstar.
Yeah, absolutely. And you can see actually at the tail end there, it gets very close to the Morningstar average. Not that we're promoting that, but you can see that's the warning zone, if you will, near retirement and retirement, and that's where it's at its lowest level with equity. Also, one other thing, you mentioned adding, the very nature of a DC plan, adding, you're actually dollar cost averaging in periods of underperformance. Don't forget also that the nature of a target date fund is actually rebalancing.
Yeah.
So that's most participants, not just your participants, most participants don't rebalance. They don't know enough to do that. But in the target date fund, you have that mechanism.
Great.
Thank you. Just one thing I would add. Can we go to slide 22 really quickly? And Ms. Yee, you mentioned the need for communication, so there definitely will be a need for communication. And importantly, people can move themselves shorter or longer if they choose to. Our participants can do that. But really importantly, I just want to mention, remember our investment beliefs, I think it's investment belief 9, is that risk is multifaceted. You'll notice that even here in this, quote, improved place, there's still a 71% probability of shortfall, which is another risk. And so we have to, early on in DC plans, they actually made the qualified default investment option, which is what covers you from a fiduciary standpoint, the fact that it's qualified. Early on, those were the cash option. They actually found that because of inflation, that was a more risky place to be. There wasn't market risk, but there was inflation risk. And so that's why we've moved to a place that a glide path can actually be considered a qualified default investment option, and it actually covers from a fiduciary duty standpoint. So that not taking risk isn't one of the options. We believe this is the best set of risks to take.
Yeah, I understand. Great, thank you.
Okay, thank you. Mr. Costigan.
Sorry, just a few clarifications. I just want to make sure. The median value is $28,000 is what you said? Yeah, okay.
Around 28.
Is that at retirement or across all active participants?
It's the median balance pre-retirement.
So that's across all active participants. Okay. The 71% probability of shortfall is 71% of the 81% or 71% of the 4%?
71% is the amount that you do not reach that 81%.
Okay, so even under this model, what we're saying is 71% of the participants are not even going to meet the 81% goal with a combination of a DB and a DC.
Correct. And remember, so that includes anybody, so you could be at 79%, you're still under your...
Well, I understand. I mean,
there's no silver bullet, if that's what you're asking. That's correct. And that's why, again, to this gentleman's point here, is it's necessary to be in growth assets to optimize return over time.
I agree. I think someone made the right statement. I mean, I look at a DC as actually where you take on more risk in order to hit your 81%. So I take a lot of risk in that side of the house, so to speak, because you're better off because you do have a DB side. So these folks, I think, can take on more risk because you have the fact you've got the DB on the backside. Because very quickly, the 13-year drawdown, is that representation between 65 and 78? Or is that 78 and then 13 years till it expires? I'm just trying to understand. This footnote 2 says, in case of shortfall, which is inevitable, since we say it's a 71%, so it's inevitable you're going to have a shortfall. Years before drawdown represents the number of years the median participant, who only has $28,000 in their account, can draw on their CalPERS 457 balance to meet any income shortfall. So I just want to make sure I understand this. There's a 71% they're not going to meet the 81. It's a 13-year drawdown, and they have a median income of $28,000. I'm just trying to do the math here. Am I missing anything?
So the 457 plan is used as a stopgap. So we know that participants retire at around age 58, but they don't start taking distributions from the 457 plan until age 65. So during that period of time, we expect them to use their personal savings, or maybe they have the other income from another person. Based on the data that we have, participants start taking withdrawals at 65. So from 65 to 14 years is when they're pulling down their 457 balance to reach that 81% replacement goal.
That's 65 plus 14 to 79?
Yes.
Okay, but we adopt a 74-year mortality table, typically for a male. I mean, I know we're probably beating this one, but when you start, this is why you gotta love math, because we're throwing a lot of numbers around, right? Because you can retire at 50, we're assuming they retire at 58, they're doing a drawdown at 65, we're adding 14 years, but the mortality rate is not that far out. So I'm just trying to get...
The mortality rate is for a two-person's household. So at a certain point when we expect somebody to pass away, the income replacement will go down.
And last question, the 28,000 then represents a two-party household? That's the median income or median
No, the 28,000 is the balance in the 457 plan
for
pre-retirement.
For a two-person household?
No, it's for one person in the plan, but all kind of income replacement projections assume a two-person household with a one-person income earner.
And one last question, Sonny. Why do we make the assumption it's two income? I mean, with all due respect, my wife doesn't work. She gave up her career 10 years ago. So where do we model a single person or a single individual with a spouse that doesn't work? Or are all of our assumptions based on a two-party
It's a two-party household, but a one-person income earner.
Okay, that's what I need to know. Thank you.
Okay. Mr. Slayton.
Thank you, Mr. Chair. I find this a fascinating conversation. I think there are only a few of us on this board who have full longevity risk. In other words, there are a few of us who don't have the benefit of a DB plan. And so we look at this maybe through a slightly different lens. Wish I had one. It would be great to be able to have this as an additional component added to a DB plan. So I think when we look at it as this addition, as this added on top of, I think our biggest challenge is that people don't use it. A $28,000 balance is sort of unbelievable as an average. I'm really shocked that number is so low. So to me, the real question is, why aren't more people using this? And I don't know whether it's just immediate gratification versus putting the money away. I'm not quite sure I understand why. But to me, that's more of an issue than the plan design. And it seems like the plan design, given that you have a basis of a DB plan, you may or may not have Social Security on top of that, which again eliminates longevity risk, says that this is, to me, that this is prudent. So I'm encouraging people to vote for this, and I would even call the question, but maybe that's not appropriate in this forum.
Then we got one more, and then we'll call for the question.
Could I just make a comment in relation to Mr. Slayton's comment, though? In other words, what we don't know is what is going to be the behavior of the participants going forward. So in other words, you have things like PEPR that are rolling through the system that could increase the importance of this plan, which is why you come back periodically to redo this analysis. This is not just set it at one point in time and it's going to run for the next 50 years without adjustment. Basically, we'll come back and we'll review this on probably a 5-year incremental basis to refresh all of that pool of information. And it is not necessarily a foregone conclusion conclusion, for example, that people are going to have a 71% probability of shortfall, because literally, if they increase their contribution by 1.5% on this recommended path, that reduces that probability to 50%. If they increase their contribution to 5%, that's going to, it's up to the participant, to exactly the point that you made, Mr. Slayton, to determine just how important is this to their overall financial picture. And that's a question that we can't necessarily answer here, and I don't think that we should necessarily be trying to build a plan that could try to account for every possibility of participant behavior. So this is anchored on the average participant in the plan and the conditions around that average. But you need to understand that, I think, with a bit of a grain of salt.
One last question. The participants do have the ability to move from the glide path approach to the other approaches. So that's totally within the control of the participant, correct? No restrictions on that. Is there timing on going in and out? In other words, if I went out of this, and then could I come right back in a month later? What's the rule? What are the rules?
So within the program, we do have some frequent trading constraints where a participant, if they're moving in and out of a fund too frequently, we do monitor that behavior because the goal is retirement savings, not market timing. But apart from those rules, participants do have freedom of choice to move between the core funds, the target date funds, and within the target date funds, they can move to a more conservative or more aggressive fund than their retirement date might suggest.
Right. So education component is an important part of this. Thank you.
At this time, I'm going to only call on members who have not had an opportunity to speak. So given that, Ms. Taylor.
Thank you. So I do appreciate this presentation, and I'm going to be supporting this as well. I just, I think I had a couple of things that I wanted to comment on, and one of them was Mr. Slayton's talking about the fact that not everybody has the pension to build on and have this 457 so that you can get to 81% of your income, which is why I joined the state of California when I joined the state of California, because your 401k or 457 or whatever it is doesn't always provide what you need. The other thing I wanted to just ask was this 71% probability of shortfall and then the average $28,000 of savings. Does that have to do with, and I know we're sort of speculating here, but I would think it would have a lot to do with, and I remember the conversations, is after the crash, a lot of people decided they weren't going to put money in their 401k anymore or their 457. So I'm wondering if that has something to do, this is very recent history, even though it's been almost 10 years, but it's a lot of us that are at retirement age. My husband lost most of his retirement, and he was retired. So, I mean, I think this has a lot to do with why these have to be considered savings plans and supplements. They can't be considered your sole retirement fund.
Yeah, I don't think we can speak to your specific plan's behavior at that time, not having been involved. But I do think there's a trend that's going on in the industry, if you will, that most participants, most plans generally looked at the 457 plan, a DC plan, as supplemental. So there wasn't a whole lot of emphasis put on over the years on contributing to that, particularly when you had a defined benefit plan. So I think there's some legacy here probably in terms of why it hasn't been utilized as much. And I don't think that that's anything different from other public state plans as well. I don't know if you wanted to add anything.
And I just want to, I think the good thing here is we're looking at this as an addition, as a supplemental plan, but a lot of folks don't have that choice.
Yeah.
Like Mr. Slayton said, right? So they are looking at a 401k outside of public work as their only source of retirement, and really that's honestly not given how 401ks have tanked in the past several times in my lifetime. It's something that we need to understand is not a primary source for retirement.
And as Eric said, this is something you want to monitor going forward, and not just the asset allocation, what we're talking about here,
Right.
but your plan participants' behaviors, and McKelly mentioned benefits change over time, which the law passed that benefits have been being reduced, so for the younger employees.
Right.
Both of those are really important points.
Right. Okay. Thanks.
Mr. Miller?
Yeah. Most of my questions have been answered, and I also, like Ms. Taylor, I'm supportive of this. Kind of two things I wanted to comment on. One, I think the slightly higher levels of risk, extending that accumulation period a little longer, especially looking at slide 21, whereas if we really were reflecting the relative risk in a more real-world way, I think the blue area would probably extend to more than cover that 4 or 5 year extension, and the complexity of trying to more closely match that would be kind of unreasonable. And looking at it in the bigger picture of this is supplemental, as these were always meant to be, to having an actual pension, which few and fewer people have these days. I don't see that as any problem for me to go with. I think I'm pretty comfortable with that. So I wanted to come back to Mr. Slayton and ask you, how do we get people to participate? And at least from my perspective, I'm a professional scientist. We're among the highest paid public servants in state government. I'm one of the highest paid scientists in state government. I'm a senior scientist. My take-home pay is under $4,000 a month in that check after you take away benefits, health care, my retirement, contributions. Public employees, virtually all of them, are paying way more into their retirements than they were a few years ago. For me and most scientists, most state miscellaneous, we're paying 60% more in than we were. We went from 5% roughly to over 8%. Our salaries have not kept up with that at all. And so for a lot of folks who have a pension, they're relying that exclusively. They're relying on their health care benefits from CalPERS not to be going up and hitting them in the pocketbook. And so the biggest thing we can do to get them to participate is to make sure they have some expendable discretionary income that they can put into some of these things, because right now people aren't participating because they can't afford to. They just don't have the cash flow right now.
Thank you. Mr. Rubalcaba?
Thank you. I really appreciate the presentation, and I do feel very comfortable with the asset allocation. So this is something I am familiar with because I am a similar board that deals with 457. But one thing that it was one of the charts, but wasn't really discussed, and I agree with everybody about the importance of participant education. So if they're comfortable, they can get the window, arbitrage window. If not, the age base, I think is the retirement age base, perfect. But I do, one of the concerns I noticed, maybe there's not a problem here, is a lot of people do the right thing. They contribute, but then they get enticed to roll over at retirement instead of keeping the money for full distribution or what have you. Is that a problem? I mean, notice there's on chart 17, C rollover. Does that mean the number of people that actually at retirement roll it over out of the plan? Is that what that means? So it's kind of low, which is good, but I think if we're going to do a robust communication program about the importance of contributing, it should also include the importance of keeping your money here so it provides the supplement to your defined benefit as it was designed. Thank you very much.
Response?
I'm sorry, I was waiting till the motion. Just I've got some summary of
No, the
points for follow-up.
Yeah, but no, the motion by Ms. Martin, second by Mr. Slayton is on the floor. But I want to know, did you have any response to Mr. Rubalcaba's comments or Mr. Miller's before we call for the vote?
Sure. Well, I'll just go quickly. You know, these are supplemental savings plan has been discussed. In terms of the fiduciary obligation of this investment committee to select planned asset allocation and glide path, I think both the expert advice from a recognized third-party expert, R.V. Coons, is before the committee. You have advice from your investment staff as well as independent third-party fiduciary, Wilshire. I think they've highlighted collectively the risks and options to your choice. The discussion amongst the committee members, I think, watching and participating have fulfilled the fiduciary obligations to be prudent in making these choices. The last piece that I was going to mention is this question of communication and education and plan design, whether I think we are for having supplemental savings plans for our beneficiaries. The question Mr. Costigan raised around Placer County, whether we have, which plans we offer and how. I think the direction perhaps could come from the committee chair that would work with the CEO to bring that back to the appropriate committee. I think communication, education, whether we offer a plan or not, more appropriately belong in the finance committee for a future date, but we could work with the CEO to schedule that for you.
Okay, so on the motion, all those in favor say aye.
Aye.
Opposed? Hearing none, the item passes. Thank you very much. We now move to item 6, which has three different components, A, B, and C. So we'll start with 6A, and these items under 6 are informational items. And 6A, dual class non-voting shares update and debate.
Yes, Mr. Chair, thank you very much. This is the first of 3 corporate governance items, 6A, 6B, and 6C, and I'll give the team time to adjust and move into the seats here. I'll be joined by Ann Simpson and Dan Bienvenu and Samiso Nzima for all 3 of the trilogy, 6A, 6B, and 6C. We'll be taking up in succession. 6A is not only a follow-up from last month, but delayed by 1 month our promise to come back and discuss dual class and non-voting shares and the debate and discussion around that very important topic is here in April rather than last March. So 6A is an information and educational item and a preview of what may or may not come over the next year to 18 months in the marketplace on this very important topic. So we'll get to that. Just to give the preview and expectation setting for the committee, 6B is a review of the principles, the governance and sustainability principles, and that too, we had some directed items to bring back with respect to the principles, one having to do with sexual harassment topic, and we have some proposed language for the committee to consider, as well as a more specific discussion around the treasurer's request to consider some enhancements or improvements or changes to our diversity principles and guidelines within our principles. So that's 6B. And then last, 6C is the most straightforward, I think, of the 3. It's our regularly scheduled item to go over our proxy season. It's one of a series of discussions around our proxy season. 6C is particularly a discussion around proxy solicitation, where we'll put both the might of CalPERS' name as well as some dollars in soliciting proxies around proxy fights coming in the current season. So that's the trilogy laid out. 6A, you'll now hear from myself, Ann Simpson, and Dan Bienvenu. I think in that order. No, actually it'll be myself, then Dan, then Ann, in that order to take you through this topic. I'm going to start. There's lots of information and background information on, what is one share, one vote, what is dual class shares, what is non-voting. I think we've had those discussions in the past, and the information is provided in the item. What we thought we would do is start really with a scene setting over, what is First, what's the debate in the marketplace around dual-class shares? What's the case on the one side for one share, one vote? What's the case for unequal voting rights, such that you see in dual-class shares and non-voting rights? Now, this is a debate in the marketplace. It's not a debate here within CalPERS. This issue is settled with respect to CalPERS' view. It's a long-standing view in our principles and a long-standing view of not only this investment committee, but the investment staff. So this isn't a debate, an internal debate. This is merely, this is importantly to show the debate within the marketplace and different market participants who see this topic with different lenses. The case for one, well, before I get to the case for one over the other that's covered here, I should say that no matter what side of the market participant ledger you are in this debate, most market participants are viewing this debate from the lens of what's in the best interest of the long-term ownership of these public shares. Both are coming from the same belief set and the same viewpoint. And now CalPERS believes that the one share, one vote has the better side of that argument, which argues that the share owners who own fractional shares of these companies, should be able to participate in the most important votes of the corporations in terms of their boards of directors and other very important governance rights. That over the long term, the ability for share owners in proportion to their ownership rights to inform and participate in these important voting rights leads to the best long-term result for share owners in holding these shares of companies for the long term. There's some other reasons listed in the bullet points before you, but in the big picture of things, that's the argument for share owners being able to exercise their ownership rights in proportion to how much they own of a given company. Now, the case for unequal voting rights in the marketplace, again, not how CalPERS is settled, is worth mentioning a bit, especially since really in the tech boom of the last 10 years, there have been more and more technology companies coming to market through IPOs with different voting structures, as well as some non-technology companies as well. And there, the long-term result, the long-term view for share performance of a company over the long term by advocates of unequal votes really believe giving some time for management of these companies to be protected from what we used to call, quite colloquially, corporate raiders, that protecting companies and managements from those types of intrusions by activists with very short-term focus is beneficial, and that will lead to a better result in the long term for many companies, if not those that are IPO'd originally. That's really the debate in the marketplace. Again, from CalPERS' own views, we're settled on this topic. There's no debate internally, and we're not proposing, or no one is proposing a debate over that from a CalPERS perspective. What we do think is important, so that now moving from the marketplace discussion and debate over dual class versus one share, one vote, now moving into CalPERS investment beliefs. And I would say some of the main tension between the question of holding companies that have shares that have disparate voting rights. What are some of the tensions that are brought up by CalPERS investment beliefs, first off, and then by our practice of holding a very broadly diversified global equity portfolio? And what this page highlights is that with many things in our investment beliefs, I think we've done a good job at the forefront, several years ago, thinking through a lot of these topics. And our beliefs really do inform our discussion around important policy topics for the overall portfolio. And this is another example where it's instructive and quite easy to actually go to our investment beliefs and see this topic and how it's framed in our investment beliefs. On the one hand, as we note, investment belief 4 really underscores our belief in governance as our primary tool to not only align interests but manage our capital. And in the global equity portfolio, our strong belief in engagement leads us to want to have very strong governance rights in order to enhance the effectiveness of our engagement efforts with the public companies that we own. This investment belief, along with our principles that are on the following page, really form the basis for our policy belief and our firm investment belief in one share, one vote. Now, on the other side of the ledger, in terms of framing a bit of more than a bit, framing attention within our investment beliefs on this topic, is investment beliefs 6 and 7. Investment belief 6, familiar to the committee, thinking through asset allocation being the dominant determinant of our risk profile and returns in the portfolio. One of our sub-beliefs that underscores that is that we aim to diversify our portfolio across distinct risk factors and return drivers. Investment belief 7, in talking about taking risk only where we have a strong belief that will be rewarded, the sub-belief that's under there really goes to particularly in our global equity portfolio, where we use index tracking, passive index tracking strategies, where we lack conviction or demonstrable evidence that we can add value through active management. Those two beliefs frame this discussion around our support for having very diversified, we say most broadly diversified portfolios possible. And when I turn it over to Dan, he'll talk a bit about our selection in this last ALM process of one of the most broadly diversified global equity benchmarks that can be selected, both from a geography and number of companies standpoint. So as we turn to the discussion of holding within our CalPERS global equity benchmark and the largely index-oriented approach to holding our global equity portfolio for the long term in as broadly diversified manner as possible in furtherance of investment beliefs 6 and 7 and our firm belief on diversification in general. It sweeps into the portfolio many dual class, and now a more recent entry into the public markets, no voting shares into our benchmark for holding. And that has occurred over the course, certainly over the course of the last 10 years, and then with respect to non-voting shares, a very new entrant into the marketplace, including I think the publicity around SNAP in particular as a example of that. The question of, well, as a long-term owner and a proponent and believer in one share, one vote, how can you own shares of companies that are either restricted voting rights or non-voting rights? And the answer really is this dynamic of diversification preference in contrast to our stated governance goals in our principles to have all companies be one share, one vote. And as we were discussing as a team on Sunday, preparing for that is how we view how we'd like the markets, how it ought to be. And like many of our principles within the governance program, not all companies are either constituted or behaving in the ways that we think ought to be. The market's a messy place. It has lots of different participants and styles. And our governance practices are really all about trying to square our own beliefs and our own views of what ought to be with how the market is actually constructed. And in this case, how our benchmark is actually constructed in the types of companies that we own. Now, before turning it over to Dan to pick up, and he can pick up our actual exposures with respect to these non-one share, one vote type of voting shares, I will note and foreshadow Ann's batting cleanup on this three-party presentation, that we do see quite a roiling debate by market participants about what is the appropriate treatment for regulators, for stock exchanges, for index providers, given this more recent development of more and more companies coming to market with restricted or non-voting share rights. We believe there's much, and we're in the thick of it. I just want to say the CalPERS staff is right in the thick of all those discussions, both regulatory, stock exchange, and index providers. We believe there's much that can happen and likely will happen over the next year to 18 months. And that's why we believe that it's worth taking our time to see how those changes will develop in the marketplace, because it will inform any choices that we want to make or don't want to make with respect to our benchmark selection. With that, there's some next steps at the very end of the presentation. I'll come back in terms of timing of all of this, but I think the main point I wanted to make as I turn it over to Dan is we do think there's quite a bit of work to be done over the next year to year and a half with other market participants, and there's some both concerning as well as favorable compromises that are out in the marketplace that we think are worth waiting for and engaging in, and see how those resolve themselves before we take any action. So with that, I'll turn it over to Dan to talk about our holdings in these types of shares.
Thanks, Ted. So as Ted laid out, we've taken this issue very, very seriously in working our way through this tension, because we do have these competing desires, right? We unequivocally believe in one share, one vote, but we also believe in diversification, and that's really where we have the challenge here. Historically, CalPERS benchmark has been the FTSE TMI, which stands for Total Market Index. And by total market, again, that's to be as broad and inclusive a benchmark as possible, which is our best chance at diversification, or the maximum diversified portfolio. Now on slide 11, what you can see is that that benchmark results in fully 10% of the global equity portfolio being invested in securities that have some differential voting structure. And of course, when you manage a $180 billion portfolio, that 10% represents nearly $20 billion. So it's a material exposure, and that's one of the many reasons why we've taken this tension so seriously. Even in the next area under MLPs and that includes SNAP, even that portion of the portfolio is over 0.5%, or about $1 billion invested in securities with no voting rights. And again, that's something that gives us pause, but it also is a material component of the portfolio, and it does add some diversification. So as we manage that benchmark, we certainly are constantly looking to add value in managing against that benchmark, and so we do indicate for and we receive IPOs as we manage that most diversified portfolio. We've indicated for and received IPOs in companies that are incredibly well governed, like Amazon, but then also others like Google and Facebook and even Snap. Now the performance of this activity, this indicating for and participating in IPOs, is candidly mixed on a case-by-case basis, but the securities do historically get added to our broad TMI benchmark, and this activity in aggregate has added performance to the portfolio. On the topic of performance, that'll take us to slide 12. In a recent blog published by MSCI, they calculate the performance of unequal voting shares versus their universe for a 10-year period from 2007 to 2017. And over that time period, for the broad ACWI universe, and ACWI is MSCI's most broad universe, for the broad ACWI universe that includes both developed and emerging markets, unequal voting rights have actually outperformed the standard benchmark by 2.5% per year. So given an approximate 11% weighting in their benchmark and the MSCI benchmark, removing them from the benchmark would have actually resulted in underperformance of the benchmark of about 30 basis points per year, which is a material underperformance. The study also found that the unequal voting rights stocks had higher growth and higher profitability, which are good things, but then also candidly higher earnings variability, which is risk, and then lower dividend yields. So it's a mixed bag on these securities. Stripping out common factors, and by factors I mean things like country, sector, and then even styles like value, growth, and things like that, MSCI found that actually the majority of the residual effect of this performance is actually stock specific. It's not factor-based exposure. So now the prospective performance for the next 10 years may or may not be like the past 10 years. But because of the material size of the exposure and the historical performance differential, your team here has taken this debate very seriously, or taken this tension very seriously, and it's one of the reasons we've been so active and engaged in working through the topic in the marketplace. So I'll use that as a segue to hand the clicker back over to Ann to take us through some of CalPERS' involvement in this and go from there.
Thanks very much, Dan and Ted, for setting the scene. Ann Simpson, Sustainable Investments Programme. My role in this presentation is really to tell the board what we've been doing to address this slide towards dual-class listings, and also the rather shocking arrival of Snap, which was the first company to list without voting rights. And we make a distinction there because master limited partnerships actually are not companies, although we've had investments and we've had some vigorous engagement, most recently around the Dakota Access Pipeline, in a situation where we didn't have voting rights and went through bank financing instead. So let me turn to the next slide. As Ted said, this is an issue which is very live and controversial in the United States, which is extremely important globally because the US is still the world's largest capital market. But it's not a topic just confined to the US. It's something in Asia that's a topic of discussion, partly because some of the Asian markets are worrying about the fact that they may have been losing out on listings, for example, Alibaba, because the US allows variations on the theme of one share, one vote. And up until now, other markets have had tougher rules, or if they've allowed dual class, it's come along with some very tough additional shareholder protections. So here, just to give a flavor of some of the discussion in the US market, the incoming a new chair of the SEC, Jay Clayton, has said it's a topic that should be discussed. In other words, he acknowledges this is something of real importance in the market. And also, Commissioner Cara Stein went further to express her view that structures where a minority of insiders lock out the interests and the rights of the majority may also have collateral effects on our capital markets. So I think what she was recognizing is that although this may seem a more attractive and welcoming listing environment, there may be some underlying concerns, knock-on effects that need to be addressed if governance standards are weakened in the bid to attract listings. Let me move to the next slide. So what we've been focusing on is how we can be part of an effort to improve the quality of the capital markets in the US. And most important there, I think, has been the Council of Institutional Investors. And they have really led the investor community in raising the issue with regulators, also with the stock exchanges, but also, very important last year, they took this to the index providers. And that matters because many investors use these indices in order to make decisions about where to allocate capital. And really a goal for a company, whether they're listed or they're growing or hoping to move from small to medium to large cap companies, is to be included in these indices, because this improves the liquidity of the stock. It also improves thereby their access to capital. So as more money has gone into index strategies, those who construct the indices and decide, well, what are the criteria? What's the price of entry into our index? These have become important and powerful players in the market. So CII engaged, and CalPERS also wrote its own letters to each of the main 3 index providers. And I think, really, as Ted suggested, there is a roiling debate, but there's also been some very, very significant response from the index providers. I think we've been very pleased to see that each of the main index providers has made a response. Now, the responses that they've made are quite different, and we've gone into glorious detail in what they're providing and offering to the users of their products in the appendix. And many thanks to Don Ponce for pulling all of that together, because it was a fair amount of work. I'm happy to answer questions on the different approach that they're taking, but the summary on this slide really says, okay, for FTSE Russell, they're basically saying you have to give a minimum of 5% of your shares, 1 share, 1 vote, which effectively excludes a company like Snap. MSCI is saying, okay, well, we're actually going to take the lack of voting rights into account when we're deciding what proportion of the free float, that's the company's shares that are actually going to be tradable in the market. So if the effect of their approach is going to be reduce the market weighting of companies with no votes, and importantly for the dual class companies as well. They're also giving a bit of a grace period to let companies sort of settle on this and decide whether to change the current arrangements. And then finally, S&P have gone further, and they're saying all future dual class IPOs cannot come into their flagship composite index, the 1500, and also they're giving a grace period for some cleaning up on this in the S&P 500. So although this is quite a complicated set of responses, I think what it's showing is a weight of money coming forward to say there are rewards for giving 1 share, 1 vote. In other words, this is a lot of carrots, a lot of access to capital being decked against, one of our principles, which is 1 share, 1 vote. And obviously, it's very early days, but it's going to be very interesting to be able to track how this has an impact. I think one effect is that it was predicted with Snap having this audacious new structure, new IPOs might copy what Snap was doing, and we might be then faced with a whole, on the one hand, we want more IPOs, we want the public markets to thrive, we're delighted to see the uptick in IPOs in the United States, but would it come at the cost of having more companies in the, and in fact, what the CII has been able to show, which is, I think, very encouraging, is although we've had this uptick in IPOs, we've held over 80% companies coming forwards with 1 share, 1 vote. So I would suggest that maybe these signals, as economists call them, signals in the market, that this matters to investors and it could actually affect your access to the quality of capital and liquidity. We might be actually having some positive impact here. So finally, on the what are we doing, we are also thinking through how we could square the circle. How could we both accept that there are legitimate concerns by companies about short-termism in the market, something very much at the heart of CalPERS concerns. In fact, Investment Belief 2 highlights the enormous importance of a long-term investment horizon and our responsibility to encourage companies, but that is not true throughout the market. We know that there are short-term traders and there are short-term raiders, and we're trying to hold the line with companies as a long-term owner. So something through our work with the Council of Institutional Investors, but also the SEC Investor Advisory Committee, where CalPERS sits, and its subcommittee on investor as owner, we're actually looking at some new options to be explored. I think it's early days for CalPERS to make a decision or for staff to make a recommendation, but we're thinking that we may be able to capture, and I'm just putting up some data from one of the new SEC commissioners who the CalPERS board will know well, because Commissioner Robert Jackson was one of the co-leads of our own Sustainable Investment Research Initiative several years ago, so a great champion of share owner rights and responsibilities. He has pulled together data showing that there is a beneficial effect, it seems, in the valuation of dual-class companies, but it evaporates after time. And that makes some intuitive sense, which is that if you have brilliant founders of companies coming to the market, that brilliance will fade. It's something we can observe over time. It's very hard for brilliance to just say it, for people to can't be at top form right through their career. It's going to, you know, and also what the company needs will change. What you need in a founder will be perhaps different when you're entering into a period of stability and major growth. So it's in these data, I think what we can see is that there is value in the dual class structure initially, but it evaporates at around the 7-year period. And what that has raised in everyone's mind is the idea that perhaps a sunset provision is something for us to look at. CalPERS currently does not have language on this in our principles. It's something quite new as an idea. And, you know, let's just quote Commissioner Jackson, because he said it so beautifully. He said, perpetual dual-class ownership, forever shares, and I would add into that, forever shares with no votes. Don't just ask investors to trust a visionary founder, it asks them to trust the founder's kids, and their kids' kids, and their grandkids' kids. So that's really some intergenerational continuity that we may not want. Anyway, we've put here sort of 3 ways that you could introduce a sunset. One is just simply 7 years, time's up. You know, another is, well, and it's a little bit like the Jobs Act, which is as you become a certain size, you know, responsibilities increase and we want more governance best practice built into a bigger company. And of course, another way of looking at it would be there are certain events. You know, what used to be, I think the British Companies Act, if you became mad, bad, or dangerous to know, something happened with the founder, you might revisit the idea that there were no votes or that there were dual-class votes. So, as I said, this is something that we're looking at as a participant at the SEC's subcommittee looking at this issue. We've helped develop the language around improving the SEC's disclosure and drawing market attention to where these variations from one share, one vote exist, so that people don't find them sort of just rather buried in the midst of a long document. They're brought to the fore. That's a good thing. And also, we know that the SEC is considering re-engaging with the stock exchanges to start talking again about how this could or should be reflected in listing standards. And, you know, until the mid-80s, it was not allowed. You had to have one share, one vote to have that listing on the New York Stock Exchange. So, as Ted said, there's an enormous amount of debate. We're very actively involved in it, not just through the investment office, but also through the legal office. As you all know, we had successful litigation led by our general counsel at a company trying to vary voting rights. So I think both on the litigation front and on our advocacy in the market, we've been in a lot of work, and we are seeing some movement. But it's all in flow as we're speaking. So with that, let me turn back to Ted to take us through the next steps. Where
Okay,
we go.
thank you.
Yeah.
We do have several questions on this particular component, but we're going to take a 10-minute break. Let's come back at 11:40. Okay, 13
Thank
minutes.
you.
Okay. Yeah. Yeah, I do. It's hard.